Markets are mixed ahead of the Fed's favorite inflation gauge, or preferred inflation gauge, PCE, out later this week. Investors hoping inflation will come closer to that 2% target, which could mean rate cuts up ahead. But our next guest thinks investors need to unwind their rate cut expectations and prepare themselves for a no landing outcome. To break it all down for us, we've got Phillip Colmar, MRB Partners Global Strategist. Phil, it's good to talk to you today. I want to pick up on the point our previous guest, Sucharita Kodali, was making about the consumer confidence index we got today. Suggesting that, look, on the one hand, consumers may say they don't feel great about the economy, but the data doesn't necessarily support that. There's a bit of a disconnect. How do you look at that?
There's been a disconnect actually on the consumer side and on business confidence, if you will, really over the past couple of years. So if you ask consumers, what do they think ahead? If you think of the year ahead or the economy situation looking out, they tend to be quite pessimistic. And this has been a sort of a false signal for a lot of those economists looking for recession repeatedly over the last 2 years. While they look pessimistic going forward, if you ask them about what do you think about your current situation? What do you think about your current job market? What do you think about your current balance sheet? Those kind of items. Are you willing to spend? They're much more optimistic. So you're seeing that big present situation gap versus the expectations. And the expectations has been incredibly misleading, whereas present situation is quite upbeat. And that's been tracking with more spending numbers. The same is true for businesses. If you ask them about the future of the economy, it tends to be quite pessimistic. This is really something we've seen post-pandemic. It's maybe the news flow is very pessimistic, maybe see uncertainty in the background, all that kind of stuff. But if you ask them about their current operations as is, and what they look for in their current business models or the coming quarter, they're much more constructive on things, and then they continue to keep the job engine going. So I think there is this disconnect. You got to be real careful with that. And unfortunately, a lot of economists like to look to the forward-looking components as their lead on the economy, and it's just been misleading.
Let's talk about what's been playing out on the markets. I mean, certainly you could argue there's been a lot of optimism, at least around tech and AI, given the rally we got last week. A bit of a pause, at least a breather so far in the sessions this week. But you have said that you think the market is getting too far ahead of itself, that there needs to be a bit of an unwind. What do you mean by that?
So I think there's two elements to the theme. The core theme of this year was that I think people, and you opened with a session, that people were betting on that soft landing scenario. So in that soft landing scenario is where you're going to get subdued growth enough to bring down or build enough slack to bring down inflation and get deep Fed rate cuts. Unfortunately, the soft landing was probably in place, according to all of our research, before the Fed pivoted. So the pivot and the bringing down of bond yields and stuff coming into the beginning of this year provided an extra shot of monetary conditions easing, if you will. And that's leading to so-called no landing or even a liftoff sort of scenario in the economy. And by no landing, I just mean we're not going to go below trend. So it doesn't allow for that slack to build up. It leads to stickier inflation prints. And so in that, it's not so bad because there's no landing scenario is good for cyclical stocks, and it's good for the risk on rally in general. The caveat to it is that it also doesn't lend way to those deep Fed rate cuts, and it means higher for a longer bond yield environment. And so when you're looking at a higher for a longer bond yield environment, you kind of want to be in places where the earnings bar is a bit lower, valuation support is going with you. And those tech stocks, that's the other part of it, they, in the beloved parts of the market, the Magnificent Seven, if you will, they've had a sharp rally. But right now, they have very elevated, not only valuations, so they don't offer a lot of valuation support, but they have really astronomically high forward earnings estimates. And when I say that, I mean, if you look at the tech sector on a multi-year basis, a long-year forecast of earnings, it's the highest we've seen since the late end of the dot-com bubble in the 1990s. So the earnings bar is high, the evaluation's there, and they need to meet it. There can't be any kind of question by investors or the consensus about the so-called moat around their business models and the idea of increased competitions or revenues continuing to generate there.
And Phil, just to clarify, in your no landing scenario, does the Fed still move ahead with a rate cut, at least one or two?
We've been pretty clear that there's no real economic foundation to have any kind of rate cut. That being said, the Fed seems determined to provide it. There will be some uncertainty with the inflation data in the near run. They'll probably give a window. So we actually think the Fed, even though there's not an economic foundation in our opinion for it, we think that they'll probably try to do 50 basis points. But the idea of doing deeper Fed rate cuts and then more into 2025 that the bond market has tried to gravitate towards has got to come out. So it's already partially unwound now, but it'll continue to unwind. So you'll get a rate cut, which we would explain as sort of misstep by the Fed. thinking that inflation's softer. There's no part of the risk asset spectrum from equities to cryptos to anything else that's telling you that monetary conditions is tight or that the world's not flush with liquidity right now. So rate cuts isn't really needed. The economy's firing on all cylinders. The job engine's still there. There's really nothing. It's a hope by Powell that there's some kind of disconnect that magically inflation is going to come down regardless of a durable economy, and that 2% is the anchor, which we find misleading. It's not going to settle that low.
And Phil, really quickly before we let you go, in that environment you just described, your top pick, name or sector?
So the top pick's away from tech, but it's going to be into we like aerospace and defense. We like energy after being beaten up last year. We do like your mega cap financials, and if you want to augment it with a defensive, we like healthcare, which is less of a bond proxy. So we find value there.